Stop everything you're doing right now. Close your other tabs, turn off the TV, because what I'm about to show you, what happened in the last 72 hours while you were watching NFL playoffs and scrolling through social media, is the single most important geopolitical signal of your lifetime. And if you don't understand what this means, if you don't position yourself in the next 30 days, you will lose everything you've worked for. Not eventually, not someday. This year, 2026. My name is William Lee, I'm 33 years old, and this morning, January 12th, 2026, I received confirmation from sources inside the international banking system of something that will sound like conspiracy theory, but is documented fact. China has liquidated nearly 48% of their US Treasury bond holdings. They've dumped over $600 billion in American debt. They're down to $688 billion, the lowest level since May 2009. We've erased 16 years of financial integration in less than 18 months, and the mainstream media is not telling you why. But here's where it gets wild. While they were selling those bonds, taking massive losses, selling at the worst possible time in a depressed market, they were simultaneously buying something else. Every single day, without pause, without hesitation. They are vacuuming up physical silver at a pace that defies economic logic. Today, right now, silver is trading at $86 per ounce and climbing. Last week it was $70. 2 weeks ago it was $32. That's a 168% gain in 2 months. And China is the buyer. Stay with me because what I'm about to explain connects dots that nobody else is connecting. The bond sales, the commodity hoarding, the silver accumulation, Basel III going live this morning, Venezuela collapsing, Russia cutting supply. This isn't a series of random events. This is a coordinated preparation for something that's coming, something big, something that changes everything. And the people who understand what's happening are moving their wealth out of the blast zone right now, today, while there's still time. Let me show you exactly what's happening, because if you want to understand the timeline of the coming global conflict, you need to stop looking at aircraft carriers in the Taiwan Strait. Military assets are theater. They're designed to be seen. They can be recalled in days. If you want to know the true intent of a superpower, if you want to know if they are genuinely preparing for an irreversible divorce from the West, you must look at the movement of sovereign debt. Debt is heavy, debt is slow, it takes months, sometimes years, to offload significant positions without crashing markets. And when the second largest economy in the world begins dumping the debt of its primary rival at a speed that defies economic logic, when they're willing to take billions in realized losses to exit the position, they are not rebalancing a portfolio. They are clearing the decks for war. This is the forensic evidence that cannot be hidden. This is the smoking gun. The US Treasury Department released data this week, data that most journalists skimmed, data that Wall Street tried to dismiss, confirming that China's official holdings of US Treasury bonds collapsed to $688 billion as of October 2025. To the uninitiated, $688 billion sounds like a lot of money. It is. But in the context of the US-China financial relationship over the past 2 decades, this number represents a catastrophic collapse. This is the lowest level of Chinese ownership since May 2009, right after the financial crisis when the entire global system was on life support. We have literally erased 16 years of financial integration. To put this in perspective, in 2013, at the peak of what economists called chimerica, the symbiotic economic relationship between China and America, Beijing held $1.32 trillion in US debt. They effectively funded the US deficit. They bought the bonds that allowed Americans to buy cheap Chinese goods. It was a closed loop of capital flow that kept interest rates low and global trade humming. That loop is broken. China has liquidated nearly 48% of their position from the peak. They have sold off over $600 billion worth of American IOUs in less than 2 years. But it isn't just the total amount that is alarming, it's the market context of the recent sales. Throughout late 2024 and into 2025, the US bond market was in a historic drawdown. Interest rates were volatile. Bond prices, which move inversely to yields, were depressed. Anyone selling US Treasuries during this specific window was selling at a realized loss. In the world of asset management, you do not sell a depreciated asset for a loss unless you're facing one of 2 scenarios. Either you're facing a liquidity crisis and you need cash immediately to pay bills, or you believe the asset is about to become toxic, that holding it will result in an even bigger loss. We know China is not facing a liquidity crisis. Despite their domestic real estate struggles, they continue to run a massive trade surplus with the world. They are swimming in cash. They have more dollars coming in from exports than going out for imports every single month. Therefore, the only logical conclusion, the only explanation that fits the data, is that the Chinese Communist Party has made a strategic decision that the US Treasury bond is no longer a safe store of value. They view it as a strategic liability, a ticking time bomb, an asset that could be seized, frozen, or inflated away at any moment. And they're right. Let me show you why. We must look at this through the lens of February 2022 when Russia invaded Ukraine. The United States and European Union executed a financial maneuver that shocked Beijing to its core. Overnight, literally overnight, they froze 300 billion of the Russian central bank's foreign exchange reserves. These were funds sitting in Western bank accounts in New York, London, and Brussels. Russia thought this money was safe. It was their rainy day fund, their national emergency reserve. It wasn't safe. It was seized or immobilized with a few keystrokes. Beijing watched this happen in real time. They analyzed it, they gamed it out, and they realized a terrifying truth. If we make a move on Taiwan, if the South China Sea conflict goes hot, if we're sanctioned the way Russia was sanctioned, our US Treasury holdings are not an asset. They are a hostage. The $688 billion they still hold, and I emphasize still hold because they haven't finished selling yet, is effectively a donation to the US Department of Justice waiting to happen. The moment sanctions are applied, that money goes to zero. Poof, gone, seized under some emergency authority or frozen indefinitely. So they're getting out. They're liquidating the position with extreme prejudice. They are willing to take a 10% or 20% haircut on the face value of the bonds today rather than risk a 100% loss tomorrow. This is what military strategists call a strategic retreat. You take casualties during the withdrawal, but you preserve your force for the battle that matters. This is a financial evacuation. It's the economic equivalent of a burn notice. They are dismantling the financial architecture that stabilized the US economy for 20 years, and they're doing it in a way that suggests urgency. Usually when a central bank wants to sell assets, they try to hide the selling to avoid spooking markets. They sell slowly in small chunks through proxies and offshore accounts. But the velocity of the recent drop, shedding nearly $12 billion in October alone, accelerating through November and December, suggests Beijing is less concerned with maintaining market stability and more concerned with capital flight. They want the money out of US jurisdiction, and they want it out now, before the window closes, before the sanctions hit, before the asset becomes permanently frozen. But here's where it gets even more interesting. Stay with me because this is where the silver connection becomes crystal clear. When China sells a US Treasury bond, the transaction settles in US dollars. The People's Bank of China receives a digital credit in a custodial account. But here's the problem. China doesn't want dollars. Dollars are exactly what they're trying to escape. Dollars are traceable. Dollars are sanctionable. Dollars are subject to inflation. Dollars sit in the US banking system where they can be frozen with a phone call from the Treasury Department. So what are they doing with the proceeds of this massive $600+ billion exit over the past 2 years? They aren't putting it under a mattress. They aren't buying euros, which are just dollar vassals. They aren't buying Japanese yen. They are engaging in the most aggressive commodity accumulation campaign in modern history. They are converting paper claims into physical reality, into stuff, into atoms, into things that cannot be frozen by the SWIFT system or deleted from a computer screen. And the number one asset they're buying, the asset they're accumulating faster than anything else relative to available supply, is silver. Every single day, Chinese state-owned enterprises and banks are buying physical silver, not paper silver, not SLV shares, not COMEX contracts. Physical silver bars that are shipped to Shanghai, stored in Chinese vaults, and removed permanently from Western markets. Today, January 12th, 2026, silver is trading at $86 per ounce. Let me repeat that because it's important. $86 per ounce. 6 weeks ago, silver was $70. 3 months ago, it was $30. We're watching a 168% gain in less than 90 days. And this is not speculation. This is not Reddit retail traders. This is the Chinese government systematically converting dollars from US bond sales into physical silver because they know what's coming. They know that silver is the most conductive metal on Earth. They know it's irreplaceable in solar panels, batteries, electronics, 5G infrastructure, military guidance systems, and advanced weapons. They know that 80% of silver is consumed and not recycled. It disappears into landfills after use. They know that annual mine production of 850 million ounces cannot meet current demand of 900+ million ounces even before strategic stockpiling. And they know that when the conflict with the West escalates, whoever controls physical silver controls the technological and military advantage. So, while Western financial analysts stare at bond yields and stock tickers, Chinese state-owned enterprises are swallowing record amounts of physical silver. This is not a commercial inventory build for industrial use. This is a strategic hoarding campaign. They are treating silver the same way they're treating oil, copper, gold, and grain, as survival assets that will determine the outcome of the coming conflict. Let me show you the scale of what's happening. According to data from the Shanghai Gold Exchange, China imported over 6,000 metric tons of silver in 2024. That's nearly 200 million ounces. That's 23% of total global mine production. And the imports are accelerating, not slowing. In Q4 2025 alone, imports spiked another 35% compared to Q3. They are buying at any price. They don't care if silver is $70 or $86 or $100. They care about securing supply before the window closes. And here's the critical part that connects everything, the timing. China didn't start this silver accumulation campaign randomly. They started it at the exact same time they accelerated their US Treasury bond sales. Late 2023, they began dumping bonds aggressively. Late 2023, they began buying silver aggressively. The correlation is perfect. The causation is obvious. They are using the proceeds from one to fund the other. They are converting American paper promises into Chinese physical stockpiles. But China isn't just buying silver, they're buying everything. Let me walk you through what Chinese cargo ships are carrying into the ports of Qingdao, Shanghai, and Tianjin right now, because this is the real story that nobody is covering. While Western media talks about Donald Trump and pop culture drama, the largest wealth transfer in history is happening at Chinese ports. First, gold, the golden pivot. The People's Bank of China has been buying gold for 18 plus consecutive months officially. Unofficially, analysis of Shanghai Gold Exchange withdrawals suggests the buying is much, much larger, possibly 10x the reported numbers. They are using dollars from bond sales to buy gold on London and Swiss markets and immediately shipping it east. Gold is the ultimate anti-dollar. It has no counterparty risk. It cannot be frozen by sanctions. By swapping U.S. debt for gold, China is moving from credit-based reserves to collateral-based reserves, from promises to things. Second, oil, the energy lifeline. China imports 70% of its oil. This is their strategic Achilles heel. In a war scenario, the U.S. Navy could blockade the Strait of Malacca and strangle the Chinese economy within weeks. To counter this vulnerability, China has been buying record amounts of oil, often from sanctioned nations like Iran, Russia, and Venezuela. They're paying in yuan or through barter arrangements, completely bypassing the dollar, and critically, they are filling their strategic petroleum reserve to capacity. Recent data indicates China's crude oil stockpiles are nearing 1.5 billion barrels when you combine commercial and strategic storage. Satellite imagery shows the construction of massive new storage farms and underground caverns. They are building a buffer that would allow them to survive a naval blockade for months, possibly years. The money for this oil is coming directly from the liquidation of US Treasury bonds. They're trading American paper for Persian crude. Third, copper and strategic minerals. This is perhaps the most telling signal. China's property sector, historically the biggest consumer of copper for electrical wiring and plumbing, is in a depression. Real estate construction starts are down 40% from peak. And yet China's imports of copper ore and concentrate remain near all-time highs, with roughly 28 million tons imported in 2024. This defies all standard economic logic. If you aren't building apartments, why do you need record amounts of copper? Because you're shifting to a war economy. You need copper for the green energy grid to reduce reliance on imported oil. You need copper for munitions. Artillery shells are brass, which is copper and zinc. You need copper for military drones, electric vehicles, naval vessels. China is cornering the market on the physical inputs required for 21st century warfare. They're also hoarding cobalt for batteries, lithium for energy storage, and rare earth elements for electronics and magnets. While the U.S. financializes its economy with derivatives and leverage, China is materializing its savings into stuff. Fourth, food security. China produces 20% of the world's GDP, but controls only 7% of the world's arable land. This is another massive vulnerability in a conflict scenario. In response, China has accumulated absolutely staggering stockpiles of grain. According to the U.S. Department of Agriculture, China holds approximately 60-70% of global reserves of corn and wheat. Not 60% of their own needs. 60-70% of the entire world's reserves. They have enough grain stockpiled to feed their population for over a year without a single import. They are trading yield, the interest they could earn on bonds, for calories and survival. Think about what this means. A nation that plans to remain at peace keeps its wealth in efficient, interest-bearing financial instruments like US Treasuries or corporate bonds. It chases the highest return on investment. A nation that is preparing for war converts its wealth into inefficient physical stockpiles. Holding 500 million tons of grain in warehouses pays no interest. In fact, it costs money to store and maintain. It has negative carry, but it has infinite return on survival. China is willingly accepting a lower, even negative, financial return today to ensure they cannot be starved, blockaded, or strangled tomorrow. This explains why they're willing to sell US bonds at a loss. Western economists and financial media mock China. Ha, they sold at the bottom. They realized a loss of billions. What idiots. This is profoundly short-term thinking that misses the entire strategic picture. Beijing doesn't care about a mark-to-market loss in fiat currency terms. They don't care if they sold a bond for 90 cents on the dollar that they bought for $1. They care about resource security and strategic autonomy. If they sell a bond at a 10% loss, but use the proceeds to buy oil that they will desperately need if the Strait of Malacca is closed by US naval forces, that is a winning trade from their perspective. If they sell bonds at a 15% loss, but use the cash to buy copper, they'll need to manufacture missiles and drones. That is strategic victory. They are trading fake wealth that can be frozen, sanctioned, or inflated away for real wealth that can be burned in an engine, fired from a barrel, consumed as food, or used to manufacture the technologies of war. The liquidation of US Treasuries is simply the funding mechanism for this stockpile. They are systematically using the proceeds from the old financial system to build the bunker for the new system. And silver sits at the absolute center of this strategy because silver is the linchpin metal of modern civilization. You cannot have solar panels without silver. You cannot have advanced electronics without silver. You cannot have precision-guided munitions without silver. You cannot have 5G telecommunications without silver. You cannot have electric vehicle infrastructure without silver. Silver is the metal that makes the 21st century work. And whoever controls silver supply controls technological and military advantage. China understands this at a level that Western policymakers apparently do not. This brings me back to where we started. Silver at $86 and climbing. Let me be absolutely clear about what's happening with the silver price right now, today, January 12th, 2026. The move from $32 in July 2025 to $86 today is not primarily driven by retail investors or speculators. It's driven by three converging forces that are all accelerating simultaneously. Force 1, China's systematic accumulation as part of their de-dollarization and commodity hoarding strategy. They are buying every single day, regardless of price. They view silver under $100 as a strategic bargain relative to its importance in a conflict scenario. Every ounce they acquire is one less ounce available to their adversaries. Force 2, Basel III regulations going live this morning, forcing Western banks to either hold physical metal to back their positions or exit paper shorts entirely. The cost of holding naked short positions just increased by a factor of 10. Banks that have suppressed silver prices for decades through paper manipulation are being forced by regulatory changes to unwind those positions. This creates structural buying pressure that has nothing to do with market sentiment and everything to do with compliance. Force 3, industrial panic from companies like Tesla, Samsung, and solar manufacturers who suddenly realize that the silver supply chain is fracturing. China is hoarding, Russia is restricting exports, Western refineries are backlogged 6 to 8 months, and if they don't secure supply now, their production lines halt. So they're panic buying at any price. They'd rather pay $100 per ounce and have the metal than pay $70 and shut down their factories. These three forces, sovereign strategic demand, regulatory forced buying, and industrial panic, have converged simultaneously for the first time in history. And the result is what you're seeing, $86 today, heading toward $100 this week, with potential to reach $150, $200 in Q1 2026 as the full implications play out. But let me show you why this matters to you personally. Because most people hearing this think, okay, interesting geopolitics, but I'm not China. I'm not a bank. I'm not Tesla. Why should I care? You should care because you are about to get caught in the crossfire of an economic war that will destroy your purchasing power, your savings, and your ability to retire. Here's what's happening behind the scenes while China exits US bonds and buys commodities. When the second largest holder of your sovereign debt decides to dump hundreds of billions onto the market, basic economics dictates that prices should crash. When supply floods the market and demand vanishes, prices fall. In the bond world, when prices fall, interest rates, yields skyrocket. If market forces were allowed to operate freely, China's exit should have pushed US Treasury yields dramatically higher than they are right now. This would be catastrophic for the US economy. It would explode mortgage rates. It would bankrupt regional banks that hold long-term bonds. It would make the interest payments on the $36 trillion national debt completely unsustainable. But curiously, that hasn't fully happened yet. Rates have risen, yes, but the market hasn't collapsed into chaos. Why? Because as China steps out, the allies are being forced to step in. Look at the data closely. While China's holdings plummet toward $688 billion, other line items in the Treasury International Capital Report are spiking to historically abnormal levels, specifically the United Kingdom and Belgium. The UK's holdings have surged to over $750 billion, putting them neck and neck with China as the second largest foreign creditor to the United States after Japan. Think about that for a second. The UK economy is roughly 1/6 the size of China's economy. The UK runs a trade deficit, not a surplus. Where is Britain getting $750 billion to buy US debt? They're not buying it with excess profits from trade like China did in the 2000s. They're buying it with borrowed money or through financial engineering in the City of London. The UK is effectively leveraging its own balance sheet to act as a shock absorber for the US Treasury market. They're being forced to do this through diplomatic and military pressure. Washington is essentially telling London, China is dumping. If you don't step in and absorb this supply, the US bond market breaks. If the US bond market breaks, the global financial system breaks. And if that happens, we can't protect you militarily. We can't honor NATO commitments. So you need to buy. Then there's Belgium. Belgium's holdings have surged to 370 billion. Is the Belgian government suddenly flush with cash? No. Belgium is home to Euroclear, one of the world's largest international securities depositories. When you see Belgium buying massive amounts of US debt in the data, it's rarely the Belgian government. It's usually proxies, other central banks, sovereign wealth funds, or custodial accounts trying to mask their activity through layers of financial anonymity. The surge in UK and Belgian holdings occurring at exactly the same time China is selling suggests a coordinated effort by Western allies. This is what I call the bag holder alliance. Washington has essentially conscripted its allies into supporting the US bond market. This is not a free market decision. Why would a rational investor aggressively buy US Treasuries right now? The US is running a $2 trillion annual deficit. Inflation remains sticky. The currency is being weaponized for sanctions. The geopolitical situation is deteriorating. Buying US debt right now is objectively a risky trade. The fact that allies are loading up anyway suggests arm twisting, financial conscription. But this strategy has a fatal flaw: capacity. China had seemingly infinite capacity to buy debt because they were the factory of the world earning real dollars by selling real goods. The UK and Europe do not have that capacity. They're already struggling with their own debt burdens, slow growth, energy crises, and demographic decline. By forcing them to buy US Treasuries, Washington is draining liquidity from its own allies. It's weakening the periphery to save the core. This creates a fragile system that could collapse suddenly if any major ally faces their own crisis and is forced to sell. China knows this. China is playing a game of attrition. They are bleeding the West dry. Every $1 billion of bonds they dump forces the Western financial system to find $1 billion of liquidity somewhere to absorb it. It draws capital away from productive investment, factories, infrastructure, research, and into the black hole of refinancing US government consumption. It's a weaponized sell-off, designed to exhaust the financial capacity of the G7 before any kinetic military conflict even begins. And here's where it gets truly scary. This shift fundamentally changes the nature of the US bond market. It used to be a market dominated by economic buyers, China, Saudi Arabia, oil exporters, who bought for profit and to recycle trade surpluses. Now it's increasingly a market dominated by political buyers, UK, Belgium, Japan, who buy for diplomatic survival and military protection. Political buyers are fickle. They buy until their own voters revolt, until their own economies collapse, or until their own currencies crash. We are witnessing the transition from a global reserve asset to a NATO reserve asset. The market is shrinking. The pool of buyers is contracting while the issuance of debt is accelerating. Let me make this personal. Let me show you exactly how this affects your life, your retirement account, your ability to buy food and pay rent. For 40 years, the 60-40 portfolio, 60% stocks, 40% bonds, was considered the gold standard of safe investing. Bonds were the ballast. They were the safe haven that protected you when stocks crashed. That era is over. The US Treasury bond is no longer a risk-free asset. It is a political football in a global economic war. It is an asset class that relies on the kindness of strangers, strangers who are increasingly becoming enemies. If China, the ultimate insider of global manufacturing and trade flows, is getting out of US bonds at a loss, you need to ask yourself a serious question. Why are you staying in? Why are you holding long-term bonds in your 401k or IRA? Why are you trusting financial advisors who still recommend safe treasury allocations when the second largest holder is evacuating the position? Here's what you need to understand about the endgame. As China continues dumping and as the allies eventually reach their capacity limit or face their own crises, there's only one entity left that can absorb the supply: the Federal Reserve. The Fed will be forced to step in as the buyer of last resort. They will implement some form of yield curve control where they print trillions of dollars to buy the bonds that nobody else wants. And when they print those trillions, the value of the dollar falls and the price of stuff, commodities, food, energy, rent goes up. This is the inflationary loop. This is the death spiral. China knows this is coming. That's why they're converting bonds into commodities now, before the dollar loses another 30-50% of purchasing power. And you should be doing the exact same thing, not because I'm telling you to, not because you trust me, but because the largest accumulator of wealth in human history is showing you through their actions what they believe is coming. Let me be very specific about what you should do, because I'm not going to leave you hanging with scary stories and no solutions. Here's the protocol. Here's exactly how you position yourself for a world where the biggest buyer leaves the market and where the dollar loses purchasing power through massive money printing. Step 1. Shorten your duration if you hold bonds. Duration is a measure of how sensitive a bond's price is to interest rate changes. Long-term bonds, 20-year, 30-year treasuries, have extremely high duration. If interest rates rise by just 1%, the price of a 30-year bond can crash by 15-20%. As China exits and as structural pressure builds on long-term rates, you do not want to hold long-duration bonds. If you need bond exposure for some reason, keep everything in short-term treasury bills, 1 month to 6 month maturities. These have almost zero duration risk and act as cash equivalents. Step 2. Follow the smart money into commodities. China is selling paper to buy stuff. You should consider doing the same. Your portfolio needs exposure to energy, metals, and real assets. This is not just about profit, though there will be enormous profit in the coming repricing. This is about preserving purchasing power. When the Fed prints trillions to monetize the debt that China dumped, the value of the dollar falls and the price of physical goods rises. If you own the commodities or the companies that produce them, you're protected. If China is hoarding oil, you want to own energy producers. If China is hoarding copper, you want to own the miners. And if China is hoarding silver, buying every single day at $86 and climbing, you want to own physical silver, not paper silver, not SLV shares that can be manipulated or settled in cash. Physical silver coins and bars that you can hold, store, and sell when the price reaches fair value of $150, $300 over the next 12-24 months. Step 3. Watch the allies for the warning signal. You need to know when the bagholder alliance is breaking. Monitor the currencies of key U.S. allies, specifically the British pound and Japanese yen. Japan is the largest holder of U.S. debt, but Japan is simultaneously fighting a currency crisis. The yen has been volatile. If Japan is forced to intervene to save the yen, they will have to sell U.S. treasuries to get the cash. If Japan joins China in selling, it's game over for the current system. Watch the USD-JPY exchange rate. If the yen crashes toward 160, 170, that's your signal that the alliance is fracturing. Step 4. Get liquid and mobile. This is the exit strategy nobody talks about. In a world where currencies are losing value, where bonds are becoming political tools, and where nations are hoarding physical assets, you need liquidity and optionality. You need to be able to move capital quickly. You need assets that hold value across borders and jurisdictions. Physical precious metals are perfect for this. Gold and silver have been money for 5,000 years. They're recognized and valued everywhere. If the system destabilizes further, if we see capital controls, bank holidays, currency collapses like Venezuela, having portable wealth outside the banking system is survival insurance. Let me address the obvious objection that skeptics will raise. Someone reading this will say, this is fear-mongering, this is doom porn. China has been selling treasuries for years and nothing has collapsed. The dollar is still strong. Markets are still functioning. This is just clickbait. Let me inoculate you against that dismissive thinking because it's exactly the kind of normalcy bias that destroys wealth. Yes, China has been selling for years. That's precisely the point. This is not a sudden panic. This is a methodical, deliberate, multi-year strategic repositioning. It takes time to exit a $1.3 trillion position without crashing markets. They've been doing it slowly enough to avoid triggering a crisis, but fast enough that the trajectory is unmistakable. And the acceleration over the past 12 months, combined with Basel III, combined with Venezuela's collapse, combined with Russia restricting commodity exports, shows that we're entering the endgame phase of this process. The dollar appears strong relative to other fiat currencies, but that's because all fiat currencies are in competitive devaluation. Saying the dollar is strong because it's up against the yen or euro is like saying you're healthy because you can outrun someone with a broken leg. You're both sick. You're just slightly less sick. The real measure of the dollar's value is its purchasing power against stuff, against commodities, against food, against energy, against land. And by that measure, the dollar has lost 30% of its value since 2020. It's accelerating, not slowing. And yes, markets are still functioning, for now, but functioning under extreme life support is not the same as healthy functioning. Markets are functioning because central banks are intervening constantly, because allies are being forced to buy bonds they don't want, because money is being printed at rates that would have been considered insane a decade ago. This is artificial stability. It's the calm before the storm. It's the moment before the dam breaks when everything still looks normal on the surface, but the cracks are spreading underneath. Another objection, if this is so obvious, why isn't everyone doing it? Because most people don't have access to the data I'm showing you. Because financial advisors are trained in the old system and they can't imagine it changing. Because normalcy bias is the strongest cognitive bias in human psychology, we assume tomorrow will look like today even when all evidence suggests otherwise. Because the people who control information flow, media, banks, government, have an incentive to keep you calm, keep you invested in their system, keep you from panic selling assets they need you to hold. But the smart money, the sovereign wealth funds, the billionaire family offices, the insiders with access to real data, they're moving. They're not moving based on CNBC headlines. They're moving based on Treasury data, shipping manifests, satellite imagery of Chinese storage facilities, and private intelligence about what's really happening in boardrooms and central banks. And they're moving into exactly the same assets China is accumulating: commodities, precious metals, energy, real estate, and physical silver. Let me bring this full circle to where we started because everything connects. Today is January 12th, 2026. Silver is trading at $86 per ounce. Basel III banking regulations went live this morning, forcing banks to stop suppressing prices through paper manipulation. China is buying silver every single day as part of their systematic conversion from dollar assets to physical stockpiles. Venezuela's currency collapsed, proving once again that fiat money dies and silver survives. Russia is restricting silver exports as part of their commodity weaponization strategy. All of these forces, geopolitical conflict preparation, banking regulatory changes, currency debasement, industrial demand, have converged simultaneously for the first time in history, and the result is a repricing that has barely begun. Silver went from $32 to $86 in 6 months, a 168% gain. But if China continues buying at current pace, if Basel III forces full compliance over the next year, if industrial users panic as supply tightens further, we could see $150, $200 by Q3 2026 and potentially $300 plus by end of year. This is not a trade. This is not speculation. This is positioning yourself on the right side of the greatest wealth transfer in modern history. You are watching in real time as the financial architecture that supported Western dominance for 50 years is being systematically dismantled. China is clearing the decks for conflict. They're willing to take losses today to ensure survival tomorrow. They're converting paper wealth that can be seized into physical wealth that can be defended. The question is not whether this is happening. The Treasury data proves it is. The question is whether you're going to position yourself before the majority of people figure it out. Because once this story hits mainstream media, once CNBC is running segments about China's Treasury exit and commodity hoarding, the opportunity will be gone. Silver will already be $200. The supply will already be locked up by institutional buyers and sovereign nations. The dealers will be sold out. The premiums will be 50, 100% over spot. Right now, today, you still have a window. You can still buy physical silver at $86. Yes, that's dramatically higher than the $32 it was a few months ago, but if the destination is $200, $300 based on the fundamental supply-demand dynamics we've discussed, then $86 is still early. You're still ahead of the curve. You're still positioning before the mainstream understands what's happening. The protocol is simple. Exit long-term bonds that will get crushed when the Fed is forced to print. Buy physical commodities and the companies that produce them. Hold physical silver as both a monetary hedge and an industrial play. Watch the currencies of U.S. allies for signs the bag holder alliance is breaking. Stay liquid and mobile. And most importantly, stop trusting institutions, banks, media, government, that have proven they will lie to you, manipulate you, and sacrifice your wealth to preserve their system. China is showing you the playbook. They're telegraphing their moves through their treasury sales and their commodity purchases. They're not hiding it. It's all public data if you know where to look. They're clearing the decks. They're preparing for a world where the dollar-based system collapses and where physical resources determine power. You can either learn from the largest accumulator of wealth in history, or you can trust your financial advisor who's still recommending 60-40 portfolios like it's 1995. This is not fear-mongering. This is pattern recognition. This is reading the forensic evidence that cannot be hidden. The $688 billion figure is not just a statistic in a Treasury report. It's a countdown clock. China is methodically, deliberately removing itself from the U.S. financial system. They're liquidating, they're converting, they're hoarding, they're preparing, and the fact that they're willing to take massive losses to accelerate this process tells you everything you need to know about how urgent they believe the timeline is. My name is William Lee. I'm 33 years old. I spent the last 72 hours confirming this data with sources inside international banking and analyzing the Treasury reports that nobody else is reading carefully. And I'm telling you with absolute certainty, the game has changed. The rules have been rewritten. The largest players are exiting the old system and building the new one. And silver at $86, heading to $100 this week, and potentially $200, $300 this year, is your last opportunity to position yourself before the repricing is complete. The divorce is finalized. We're just waiting for the house to be sold. And when it sells, when the market fully prices in what China has been doing for the past 2 years, when the allies reach their limit and can't absorb any more supply, when the Fed is forced to print trillions to monetize the debt, That's when everything changes. That's when the dollar loses another 30-50% of purchasing power. That's when silver finds its true fair value at $200, $400. That's when the people who positioned early preserve and multiply their wealth while everyone else scrambles to understand what happened. Don't say you weren't warned. The data is public. The pattern is clear. The exit is happening. The only question is, are you getting out of the burning building or are you waiting for the fire alarm?